You. So first, I want to thank you all for joining us on this special day. I know you're all excited for the federal holiday, but we have amazing panelists today. This all started when we actually wrote comments in response to the RFI on the 203K mortgage program. So I want to start by just letting you know that Simone Griffin will present first. So she's with Home for USA. She'll discuss a little bit about her experience with this program, and then we'll pass it over to Deborah Peacock, and she will explain more about the 203K Rehab Mortgage Insurance Program, along with Andrew Cianci at the end. And Jeffrey Zittelman from Fannie Mae will also present on Fannie's HomeStyle renovation loan program, and Catherine Houlihan, as well as David Westfall, will present on Freddie's Choicer renovation mortgages. And last but not least, Jim Reagan will present, and he's with the Advisors Mortgage Group, and he helped us a lot with our RFI. So a special thank you to him, and thank you to all the panelists for joining. And that is all. I'll pass it over to Simone. Thank you.
And thank you, Christy. Great to see. Well, I'm not seeing everybody. You guys are seeing me, but great to be here. I am, again, Simone Griffin with Home for USA. And the reason this topic is so passionate for me, because my first house I bought with a 203K loan. And really, I got to a space where I wanted to buy every property with a 203K loan or just some kind of construction. The property that I found when I first bought my house, this was years ago, the house actually had a hole in the ceiling, and there had been a fire, and just a small world. For those, well, you guys have probably heard the story of the Loving couple, who was the first couple to integrate I guess they passed the law. They helped pass the law. They ushered in the law for integrated marriages in Virginia. Loving versus Virginia. I think that was 1967. Anyway, while they were fleeing Virginia, they lived in my house prior to, obviously before I was born and everything else. But so the house has a lot of history, and the neighborhood was one that was changing. But all of the homes were older. All of the people were older. This was an elderly neighborhood, and the house was in distress. So I got the 203K loan. It took 8 months. I found a contractor. I learned so much about the process. And I have to say, I think my ignorance of what it took to renovate a house was probably beneficial for me, because I was able to get a contractor and we secured them. And I did ask my father for kind of oversight, and he helped, but he wasn't the driver. I was the one that was responsible. I was the one that showed up. I learned several things, like ask a lot of questions and don't be intimidated and all of that, being a single woman buying a house. And I got what was really a great deal. It ended up that I bought the house for $30,000. I put $100,000 in it. And ironically, before the house was even finished renovating, I got an offer for $200,000, which would have obviously been more than I had spent or put in. But I decided to keep it, and I'm really glad that I did. The house has appreciated 8 times over since then. And of course, I have used it. I designed it in the way that I wanted to, which is I created a basement apartment, which is now Airbnb. And it was crafted in a manner that I knew would work for me and I knew would sell. And I don't mean highly like personalized to Simone. It was things like their house was originally a 3-bedroom, 1 bath. Because it all had to be gutted and torn down, I changed it into a 3-bedroom, 2.5 bath, took out the stairs leading into the basement, those kinds of things that you can do in a property that needs work. A lot of people feel like they want to move in ready home, which I totally understand. It does make things easier. However, when you do a move-in ready home, remember you are paying for the contractor who's already done the work. You're also paying a premium for the developer who facilitated the project. So doing it yourself, just like many things, especially if you find a quality contractor, can work very, very well for you. So I really love the process. I tried it again last year, and that one was not as easy. I did find this time that was with my fiance, and this is his first time going through the process. So he was excited about the idea of getting things that he wanted, but he too would have been more in a move-in ready mode. So, and I do understand that intimidation. If this is your first time doing it, you want to know what you're getting into, and you don't want to spend a lot of time dealing with rehab. Well, anyway, in this time I found a house that I loved. It was so bad that you had to sign a waiver to walk in. This is the type of stuff that I'm looking for right now. And in a market like DC where I live, that's the type of house that most investors buy, and then they're able to flip it and, make a lot of money off of it. I wanted that house and have the built-in savings of the work that could be done. Found it, loved it. I was advised against the 203K loan by a couple of entities, but I was sent to the conventional version of that product. And the problem that I had with that product was that it took 50 days to close, as in 50. And, very few sellers of distressed homes especially want to wait that long. They are trying to get that off of their books and move on. And so this is what happened with me. And I had to figure out a workaround very, very quickly, which ended up happening, but it meant not utilizing any of those products. So eventually, unfortunately, the house did not go through because that same seller wanted to, the seller basically, the title would not clear. And the seller did not want to wait. So she must have had some other options, which is perfectly fine for us. And it ultimately wasn't the house for us. But I highly, highly, highly recommend rehab loans. You get so much more for your money. You can craft the house in the manner that you want it. You can use architects and contractors and others to help you craft it. But it really changed the neighborhood that I was able to buy in. I can buy, understanding this option as a tool for me, I can buy in neighborhoods that may be considered out of my price range. If I buy a house that needs a lot of work, and I have a sense of how much things are going to cost now, having gone through it, and even dealing with renovations or rehabs and upgrades on my current house, I have a better understanding of how much things cost. I would just suggest you not be intimidated by the process of what feels like doing everything yourself, because there are professionals in this industry. There are professionals who know how to make this easier for you and give you the home that you really, really want, and the way that it works well for you. Like, one thing that I'm doing now is adding in a lot more storage. And I started off with adding more storage into the house because traditional row homes in DC don't have that. That's just a small option, that small example of the benefit of rehab loans. So I really encourage you to encourage your clients to consider this. You will have to work on the notion of paying for rent while paying your current housing expenses while paying the new housing expenses. But you housing counselors are some of the most creative people I have seen in terms of making sure that people get from 0 to 100, they get their goal accomplished. So I am sure that where there's a will, there will be a way, and you guys will be able to figure this out in a manner that supports. So I just wanted to share that with you guys. This is an awesome product. I have used it and I will continue to use it for any house. I actually don't want to buy any house that is already completely renovated. And when I have looked just to support my fiance and looking with him, I always walk into the house and see something that I don't like and something that I would want to change on houses that have been renovated already. So that's why it serves me to say, how can I craft this in the manner that works for us and our lifestyle? So with that, I'll turn it over to you, Christy. If there are any questions, guys, put it in the chat and I appreciate it. Thank you.
Thank you so much, Simone. And I'll pass it over to Deborah Peacock and Andrew Cianci from HUD.
Sorry, I was just unmuting myself. It is wonderful to follow Simone and hear her personal story about the 203K program. It makes our program so much more meaningful, hearing people's shares like Simone. Well, welcome to today's presentation. Thanks to the National Housing Resource Center for inviting us to participate in today's event. My name is Deborah Peacock. I am a single family housing advisor with the U.S. Department of Housing and Urban Development. I'll be co-presenting today with Andy Cianci, the Director of the Appraisal and Underwriting Division at the Philadelphia Home Ownership Center, who will be handling the questions and answer portion of the segment of the program. So this is just a brief overview of the 203K and limited 203K programs. We're doing the 10-15-minute version for you all. We can go into a deeper dive at a future date, or if you have any questions, you can let us know. Next slide, please. 203K might be a very valuable tool, as Simone explained in her story, in your home ownership toolbox. You may wish to discuss this option with your lender and take advantage of housing counseling agencies in helping you through this process. This program allows you to make improvements after closing. Making property improvements is a way to increase that property's value and build generational wealth. 203K loans can be refinanced. So if rates ever go down, you could refinance at a lower rate. And let's keep our fingers crossed that rates actually go down, right? So instead of getting a separate loan to make improvements, borrowers can roll improvements into the mortgage. So you don't have to have a separate home equity line of credit or another loan. You just have one loan that includes the improvement and the mortgage. Next slide, please. 203Ks must meet the same as the 203B requirements for down payments and the mortgage insurance premiums, which we refer to as MIP, and minimum property requirements, which again, we have an acronym for that, MPR, once the improvements are completed. 203K loans usually require MIP for the life of the loan. So that's something to consider in developing a game plan for yourself for home ownership. Next slide, please. Acceptable property types for the 203K loan program include 1 to 4 unit single family structures, condos, manufactured housing, mixed use properties, and REO properties. And these are HUD real estate owned properties. And if you'd like further information about REO properties, please check out the HUD Home Store website at www.hudhomestore.com. Next slide, please. There are 2 primary FHA programs for rehabbing a home. We have the standard 203K, and these are for major repairs, and the limited 203K, and that's a program for minor repairs. Now let's look at each program. Next slide, please. And this is let's do a deeper dive here into the standard 203K. Next slide. 203K allows you to make major renovations, as we talked about, and Simone shared in her story, to a home by rolling in the cost of the repairs into the mortgage. The advantage is that the loan amount is not based on the appraisal value of the home before the renovation, but instead on the projected value after the repairs are completed. This allows you to buy a fixer-upper that may not have been affordable otherwise. The loan must be for a minimum of $5,000, and you are required to use a HUD consultant for this program. This would be used for, major improvements like major structural changes, repairing a foundation, bathroom and kitchen, complete remodels, adding on a room, or finishing a basement, very substantive repairs such as those. Next slide, please. Now, 203K proceeds may not be used to finance the purchase or repair of luxury items. I know this doesn't really even need to be said, but we have to say this. It seems like common sense, right? Improvements that are not part of the property or improvements that only benefit the commercial portion of the property in case of a mixed use property. Next slide, please. Now, the 203K consultant is one of the most important players in making sure that is the most important player in guiding you to make sure that repairs are completed. The consultant must be on FHA's approved consultant roster, and they're going to inspect the property using what's called a 35-point checklist. The report addresses deficiencies that exist in the property and certifies the condition of major systems. They determine what repairs are needed to meet, again, that acronym MPR, minimum property repair requirements, and local code requirements. They prepare exhibits, work write-ups, cost estimates, and they're going to review work before draws are dispersed. They review change orders and keep the mortgagee up to date as to the project status or any issues. Next slide, please. The mortgagee must obtain from the 203 consultant an acceptable work write-up, cost estimate, architectural exhibits, 203 consultant certification, and the consultant borrower agreement. Next slide, please. It's imperative the consultant be the eyes and ears of the lender. They must inform the lender of any work stoppages, deviations from the write-up that have not been approved, and health and safety issues. Next slide, please. The mortgagee must ensure work is completed on schedule and that the workmanship is acceptable. And when the mortgagee is notified of an issue, the mortgagee must intercede in these disagreements among borrowers, contractors, and/or consultants. Next slide, please. Here we have an outline of the 203K origination process that might be helpful in understanding, how the process works. However, we've highlighted number 7 here for you because of these steps. This perhaps may be one of the most important parts of your project. Borrowers should make sure that they do their due diligence in hiring a contractor. Next slide, please. There's some common sense rules in hiring a contractor, such as reviewing their credentials, their experience and references. And make sure your contractor is licensed and insured. And in today's world, you may want to visit their Google Yelp reviews and social media pages to assist you in the selection process. If you see their work and, you like their work, this might be, to see if you guys are on the same page. So utilize all information that's available to you to see if the contractor is a good fit. Next slide, please. Okay, we're ready to begin. So here we have the steps from beginning to end to help you in the process. And I'm not going to read all of this. You guys can access the PowerPoint if you'd like to read each element in greater detail. Next slide, please. Now let's go to project completion. At the final draw, when that is requested, the borrower must authorize that the work is completed by completing what's called a release. The consultant must verify that the work was completed, and it is at this time the remaining rehab escrow account funds are released. Next slide, please. Now let's look into the limited 203K. Next slide. The FHA limited 203K program is nearly the same, but this one is used for minor non-structural repairs. It has a limit of $35,000, and you do not need to use a HUD consultant. However, if the property is located in a qualified opportunity zone, in that case, the loan amount is limited to $50,000. Next slide, please. With the limited 203K, you can make repairs such as, repairing minor plumbing, installing a new refrigerator or other appliances, installing new windows, repairing decks and patios, and eliminating health and safety hazards. Both 203K at regular 203K and the limited 203K programs can be used in conjunction with other FHA programs, such as the FHA Energy Efficiency Mortgage Program and the Solar and Wind Technology Program. So don't forget about these programs as well to help you make the property as energy efficient as possible. Next slide, please. Limited 203K requires a work plan detailing the repairs and or improvements. The borrower can prepare the work plan themselves or have a contractor prepare one. Next slide, please. Repairs must have a cost estimate that states the nature of the repair and the associated cost along with labor and material cost. Next slide, please. At closing, your lender can disperse the permit, origination, and discount fees. Next slide. Okay, let's talk about appraisals. Next slide. Now, the lender needs to determine the adjusted as-is value and after improved value for the loan. Now, to do this, the lender will use the consultant's write-up and cost estimate. On a 203K, the lender will use the work plan, contractor proposal, and cost estimate. Next slide, please. The adjusted as-is value is calculated using the purchase price less any inducements to purchase, or what's called the as-is value, or the as-is value, excuse me. Next slide. To establish the after improved value, the mortgagee must obtain an appraisal of the property, and this appraisal will include the repairs and improvements. Next slide. And if you would like further information regarding the 203K program or any FHA issue, feel free to contact us at the Resource Center. You can contact us via the website, which is listed here on the slide. You can contact us at 1-800-CALL-FHA. And if someone has a hearing issue, we can also assist persons who have any kind of disability issues as well. And here we've attached some helpful links if you would like to drill into any of these issues further or have any other informational needs. We have a link here for the HUD handbook, the Resource Center, some archived webinars and other resources. If you had, thank you so much. Next slide, sorry. Thank you so much for attending. We really appreciate this opportunity to talk to you guys today. The National Housing Resource Center is an important resource in your home ownership journey. Thank you so much. And I turn it over to Jim. Thank you so much. Bye-bye.
Hi, this is Jeff Zeidelman. You can't, hopefully you can see my video. I'm from Fannie Mae. Welcome, and I want to thank everyone for taking the time out of your day right before a long holiday weekend to hear our description of Fannie Mae's HomeStyle renovation and energy loans. Next slide, please. We have a servicing guide and a selling guide, and those documents govern what govern our policies. So if there's any discrepancy between what you hear today, or if you don't understand something, the servicing guide and selling guide are what governs. We also have some. I also have a slide from our economics group speaking to today's housing market that is also their opinion and doesn't necessarily represent the opinion of Fannie Mae. Thank you. Next slide, please. So the issues facing today's housing market, as I'm sure you're aware, the housing stock is aging. The average age of a home is about 40 years. In some parts of the country, the average age is over 60 years. These homes definitely could benefit from renovations and energy efficiency improvements as well. Certainly, new affordable home production is not keeping up with demand. So the scenario that was described earlier, where there was a fixer-upper that had a hole in the roof, that is a very common use case that borrowers use our products to address. With a Fannie Mae HomeStyle renovation loan, you can purchase a property that is in disrepair or needs repair, and fix up the home and bring it up to make it your dream home before you move in. Interestingly, you can even include up to 6 months worth of mortgage payments in the renovation. So you can include some costs that are slightly outside of the renovation. Turnover's at a 30-year low, and it's going to remain there for a while unless the interest rate environment changes dramatically. As I'm sure you're seeing, people who may have 2.5% or 3% or 3.5% mortgages may want to hold on to them for quite a while if they perceive mortgage rates are going to stay where they are. Next slide, please. Indeed, single-family home construction remains depressed, but what's the positive note that I would mention here is that active listings are up about 60% year over year. So that, while it certainly isn't to the point where it's a buyer's market by any stretch, there certainly is more supply to choose from. Some of that supply could be a fixer-upper and could be someone's dream home with renovations. Next slide, please. Next slide, please. Oh, thank you. Go ahead. So what is HomeStyle renovation? It's a loan that provides borrowers with the ability to purchase and renovate a home all within a conventional first mortgage. So you don't need 2 loans to do it. It is similar to the product, to the 2 or 3K product that you heard about earlier in this session. There are some differences, and I'll go over a few of them shortly. That use case that's mentioned right here, where you can purchase and renovate a home, is exactly the scenario that I was referencing earlier that Michelle had described about a DC row house, where someone could use a Fannie Mae HomeStyle renovation loan to purchase a fixer-upper and improve that home with that single mortgage. So it could be preferable to other financing mechanisms like credit cards or home equity loans, or even cash. There may be a good reason, or put it this way, it is a choice that should be evaluated as one of many options that are available to pay for the renovations of a home. The obvious benefit is to a borrower and a homeowner is that you're making those payments over a 30-year term. So you don't have a short horizon to pay that back. It's not a construction loan that, for example, has to be refinanced after the construction is complete. It can also be used to refinance a mortgage on an existing home and make renovations. So this is not as common today with higher rates. If somebody has a 3 or 4% rate, we certainly wouldn't encourage them to refinance it at 6 or 7% just to make renovations. But we certainly not, we don't know where interest rates are going to be, a year from now, and it may refinancing may again become viable. Next slide, please. HomeStyle Energy is kind of a small size or a more limited version of HomeStyle renovation. HomeStyle Energy enables borrowers who are purchasing and refinancing, that same group earlier, to include energy or water or resiliency improvements with their loan. One of the more common uses of it is actually to consolidate existing debt, because we also allow borrowers to consolidate existing energy-related debt, like a solar loan or a PACE loan. A PACE loan is a special sort of contractor loan that was used in a few states, I believe Florida and California and Missouri, that can jump the priority queue in a foreclosure, and and is often a hurdle to a sale. So if you hear of borrowers who might have a PACE loan, you may want to think about HomeStyle Energy as a way for them to pay off that PACE loan, and to remove some of the issues that come with it. So both HomeStyle Energy and HomeStyle Renovation are a unique opportunity to finance improvements at a lower interest rate than many other options. And I'll mention that, even though interest rates are high now, the other choices that are available might be higher still. So, we need to look at things in the, relative to the other choices. Next slide, please. The benefits of HomeStyle loans to borrowers is that it's a cost-effective way to make improvements without using home equity loans or more costly credit cards, et cetera. Borrowers can also qualify for a CLTV or combined LTV of up to 105% with what we call a community seconds loan, which is like a down payment assistance loan that might be forgiven over time or might be interest-free, et cetera. A lot of the down payment loans are actually forgivable over time. That's a good example of a community second. Next slide, please. So I want to share the differences between these two products. HomeStyle Renovation lenders have to be approved to deliver those loans to Fannie Mae prior to completion of the improvements. HomeStyle Energy does not require any approval. There are really no restrictions on the improvements that can be done with HomeStyle Renovation. It could be done it could be used, for example, to add an ADU. You can include up to 6 months worth of mortgage payments. There aren't a list, if you will, of approved renovations or approved improvements. I mean, everything has to be permanently affixed to the property. You can't use it to, for example, stock your freezer or to to buy furniture for the home. So that's really the only restriction, is that it's got to be part of the real property. It's got to be part of the property or part of the home. It can't be personal property. Again, no restrictions on the type of renovations. The maximum amount for improvements is 75% of the as completed value. So the improvements can be quite substantial. And that example of a fixer-upper, a use case might be, or a typical scenario might be, where a borrower is purchasing a fixer-upper for, say, $150,000 and puts another $150,000 into the product, into the home before, in renovations. Well, that we ask the appraiser to value that home, or estimate the value of that home as if the improvements were made. So it's we call it as completed or as subject to appraisal, similar to what the gentle lady from HUD described earlier. The improvements are just limited to 75% of as completed value. So in that example where a home was purchased for $150,000 and $150,000 worth of improvements were added, let's say for the sake of argument that the appraiser looked at that home and said that home is going to be worth $250,000. That's my estimate of what that home would be worth when these renovations are completed. The loan amount would be, the borrower could borrow up to 80%, 95%, even 97% for a first-time home buyer of that $250,000 amount. And the renovations can be up to 75% of that $250,000. And off the top of my head, that's about $187,000. So the renovations can be, renovations are not limited to a relatively small number. That the renovations can be the majority of the as completed value. You can do anything with a renovation short of tearing down and reconstructing the home. you could do a gut rehab with a HomeStyle renovation loan. And we indeed see that most renovations are quite substantial. Most people who are using renovation loans are making, high 5- and 6-figure renovations to their homes. HomeStyle Energy, the improvements tend to be much lower. The reason being that typically energy improvements, even solar panels, aren't $100,000 improvements. There tend to be, low to mid 5-figure improvements. And as such, the limit for HomeStyle Energy is 15% of the as completed value. If you're purchasing a loan, there's actually a calculations that's made. It's 15% of the lesser of the as completed value or the purchase price plus improvements. So that was similar to the description that the gentle lady from HUD had described earlier. One very interesting use case with HomeStyle renovation is to make renovations to an existing manufactured home. You can use this product to do so. The renovations are limited to the lesser of $50,000 or 50% of the as completed value. So the renovations are slightly limited. We've even seen people use HomeStyle renovation to add a manufactured home ADU. So many accessory dwelling units actually are being done as factory built units that are shipped to the home or shipped to the purchaser on a truck and installed by a crane on a foundation that's built for it. It's not your typical mobile home, so to speak, but it wouldn't be a mobile home, for example, on wheels. It's actually placed on a foundation and is permanently affixed to the property. This is a sort of, trying to give you all a feel for the range of improvements that this could be used for in this day and age where accessory dwelling units are becoming more common improvements. That you can use this. I did think I just saw a comment about prefab. I interpret prefab almost as modular, where you're purchasing the sides of the house and it's put together. What I'm talking about with a manufactured housing ADU is the entire home is built and is shipped to you on a truck. That's what I was mentioning, but we can certainly take that offline, and I'd be more than happy to do so. Next slide, please. You can also use HomeStyle renovation with our Home Ready loan. Home Ready is our affordable product that allows low-income borrowers to take advantage of features such as lower interest rates, lower down payments, down payment assistance, and cancelable mortgage insurance. These products also come with lower loan level price adjustment charges that were described. That we have a short discussion earlier in this call about the loan level price adjustments from Fannie and Freddie. And Home Ready is a product that's available at present for borrowers up to 100% of area median income. The area median income where I live in Washington, D.C. is I believe it's about $130,000 to $140,000. So it's available to borrowers with incomes up to that level where I am. Fannie Mae has a tool, and you may even know what the AMI is in your area. But again, this product's available to borrowers with incomes up to 100% of AMI. It can also be used with down payment assistance. Fannie Mae is working with borrowers in many markets to make down payment assistance available to them, and again could be used with a mortgage that renovates a property. Next slide, please. I wanted to mention one thing that's coming up from the U.S. Department of Energy, and this is their material I just copied verbatim. But the U.S. Department of Energy is coming out with incentives to encourage homeowners to make their homes more energy efficient. Low-income homeowners will receive higher incentives. I know that you may not be able to read this, you may need to zoom it, but I or focus in on it. But I've highlighted on the right side the improvements the DOE is planning to come out with later this year or early next, where they will provide a rebate of up to 80% of the project costs for a borrower who improves the energy efficiency of their home by at least 35%. And the DOE is working on those tools now. DOE is working on those tools now, and as one of the other highlights on the left side of the slide mentions that they're rolling this out through states, and they expect this to be launched in late 2023 or early 2024. But I could see, and I would imagine, that counselors will see some demand for their services from borrowers who wish to access these rebates. My experience with energy loans is it does not cost $50,000 or $100,000 to make your home more energy efficient. The typical improvements, the most important improvements to make a home more energy efficient are to seal the home, to caulk it and remove the drafts and make the living environment tighter from an air leakage perspective. And those improvements are, those improvements, like I did an energy assessment of my house, and the improvements in my house that were required cost in the neighborhood of $7,500 to make my home more energy efficient. That, I don't know if you'll encounter similar quotes, but I would suspect that you may. And if you're able to make a borrower's home more energy efficient for $7,000 or $8,000, and the government will provide you a rebate of up to 80% of that, that would be that could be a very wise financial move for a homeowner to make. The highlight or the shaded material on the right side of the slide also references the rebates for higher income borrowers. They get rebated a slightly lower amounts than lower income borrowers do. The dividing point between lower income and higher income is 80% of AMI in this case. We've also examined another offering from the Department of Energy for very low income borrowers called the Weatherization Assistance Program, which provides energy efficiency improvements at no cost to very low income borrowers. Different states have different requirements, but in general, most states use $60,000 of income for a family of four or a household of four. And again, for households that qualify, again, $60,000 of income for a household of four people. Households that qualify for that are eligible to receive energy improvements to make their home more energy efficient at no cost to them, not even an out-of-pocket cost that gets rebated. So I would encourage housing counselors to keep an eye out for opportunities and from borrowers and homeowners who might be asking for your assistance in accessing these rebates. Next slide, please. So in summary, the product is flexible, can be used with any renovation product. We don't really have a limit. It's affordable. You can bundle it. You bundle the renovation with your existing mortgage. It can be combined with Home Ready to provide lower costs for low-income borrowers. And it's really, we price it and execute it the same as a regular loan. So it doesn't cost a lender any more to do, we don't charge a higher interest rate for these loans. The lender might charge a slightly higher fee because they indeed have higher overhead, and they have to monitor the construction. They have to disperse funds. They have to oversee the general contractor. But we do not charge higher interest rates for that. Next slide, please. I've included a number of pointers to I've included a number of pointers for the participants to access. And if you have any questions, please feel free to get in touch with me or with me through the team that put this event together. Thank you. Next slide, please. Thank you. I appreciate your help. And I will pass it on to my counterparts at Freddie Mac.
Thank you so much, Jeff. Good afternoon, everyone. My name is Catherine Houlihan. Most people call me Kat, so feel free to call me Kat. And I am a member of Freddie Mac's Duty to Serve team. Alongside my colleague, David Westfall, we will share with you Freddie Mac's renovation offerings, which include Green Choice mortgages and our Choice Renovation suite. I'm really happy that Jeff's presentation ended with their energy products, because we'll start with the energy product and then move into our renovation products. Next slide, please. So I'll begin by providing an overview of Green Choice mortgages. I'm beginning here because renovations that make homes more energy efficient can help reduce utility costs and increase housing affordability. For example, the typical US family spends at least $2,200 per year on energy bills, with nearly half of these expenses being used for heating and cooling. So by incorporating technologies that help make homes more efficient, Energy Star, a joint program of the US Environmental Protection Agency and the US Department of Energy, estimates that homeowners can save roughly $200 to $400 annually on their energy bills. So Freddie Mac developed our Green Choice mortgage offering to help mitigate the impacts of inefficient energy features that lead to higher utility costs. With Green Choice, Freddie Mac makes it easier for customers to finance energy efficiency improvements and help lower utility costs. Next slide, please. With Freddie Mac's Green Choice mortgage offering, clients could be able to enjoy lower utility costs, finance new or pay off existing energy and water efficiency improvements, purchase a home and finance future energy efficiency improvements or repairs, and close the mortgage before completing the improvements. Next slide, please. Through Freddie Mac's Green Choice mortgages, energy efficiency improvements can be more affordable. Green Choice streamlines financing for improvements. It finances improvements of up to 15% of the as completed property value, and it allows for a single closing on projects. Green Choice can also be paired with Freddie Mac's low down payment mortgages, providing more financing options to clients. Additionally, paying off existing debt on previous renos could be eligible as well. And an important factor to consider is that Green Choice mortgages only require an energy report if the aggregate costs of improvements exceed $6,500. Freddie Mac's Green Choice mortgage can also be combined with our Choice Reno offerings, and my colleague David will cover that in a minute. Next slide, please. Green Choice mortgages can be used to finance basic energy efficiency improvements like replacing air conditioning and heating units to high efficiency units, purchasing high efficiency fridges and freezers, and installing solar water heaters. And according to Energy Star, programmable thermostats can save consumers roughly $180 per year in energy costs. Tankless water heaters are designed to save energy by heating water only when needed. They are similar in cost to traditional gas water heaters, but are roughly 30% more efficient, according to the US Department of Energy. Lighting can make up 10 to 20% of the home's total electric use. So installing automated dimmers, timers, and smart bulbs could lower electricity bills and increase the life expectancy of light bulbs, for example. And then Blinds and drapes can be programmed to close during the hottest part of the day to block out the sun, which works to cool the home. In the colder winter months, they can open up to allow the sun in to warm the house and help regulate the room temperature. And most of the improvements listed here could cost less than $6,500, which means that the projects most often do not require an energy report, which eases that process a bit. Next slide, please. And we've included this slide here as an example of how to help clients calculate the maximum loan amount for Green Choice mortgages. For example, if the property's sales price is $250,000, then the maximum allowable reno cost would be $40,500. And with a minimum of 3% down, they'd be looking at about $8,100 for their down payment for their entire loan to acquire and improve the property. Next slide, please. And we included a few links and resources that you can share with your clients that further delve into Green Choice. And now I'm going to pass it on to my colleague David to go over our Choice Renovation Suite. Next slide, please.
Yep, thanks, Kat. I'll be talking about our Choice Renovation projects. You can go to the next slide if you would. So Freddie Mac's Choice Renovation Mortgage can be a great solution for many of the remodeling projects that your customers may have, such as maybe the aging housing stock, maybe outdated home features, maybe some necessary repairs due to natural disasters. They can help you rebuild, and you can also make your home more resilient as well. Next slide. So Choice Renovation is a convenient and cost-effective mortgage for those looking to purchase and renovate a home with a one-time close. It can also be used to make home improvements and repairs to your existing homes through a refinance. It can also be ideal for first-time home buyers or home buyers looking to age in place, or maybe for multi-generational households. For example, you may be looking to create an in-law suite or just some extra space or living areas in your house. So this is really geared towards those larger, more major renovation projects. Next slide. Choice Renovation can also be combined with our other low down payment products, such as Home Possible, our Home One, and the Green Choice mortgage that Kat just discussed. So your borrower receives the benefits of both products. You can combine them together for the features and enhancements of sort of all of our mortgage products, which can make the renovations even more affordable by taking advantage of all the benefits of all these products. And of course, those renovations and repairs and improvements may also help increase the value of your home. Next slide. Okay, some additional detail on Choice Renovation. So as I previously stated, Choice Renovation supports a broad range of projects, including preparing and recovering from natural disasters. It can help address the aging housing supply and aging in place housing solutions. You can finance renovation costs up to 75% of the as completed value, and allows you to draw up to 50% of material costs at closing. This product can also be used for manufactured homes. You can finance improvements costing as much as $50,000 or 50% of the as completed value of the property. So whichever of those ends up being less. Another great feature of the product, it can also be used to finance up to 6 months of PITI, so principal, interest, taxes, and insurance. You can roll those into the mortgage because you recognize that while the home is under construction, the borrower may not be able to reside in the property during all the construction phases. We allowed up to those 6 months to be rolled into the cost of the mortgage. It can also be used to add an accessory dwelling unit to the property that Fannie referenced earlier. And for those who may be unfamiliar with an accessory dwelling unit, Freddie Mac considers an ADU or an accessory dwelling unit to be an additional living area that has to be independent from the primary residence, and it has to include at a minimum a kitchen, a bathroom, and a separate entrance. You can also advance up to 100% of the closing cost materials and up to 100% of the renovations that are in the contract, which can be used as labor, and it can go directly to a home improvement store. So using a home improvement store and they require payment in full for the renovations, those funds can be dispersed to them in lieu of doing an escrow account. That way they can manage disbursements to their contractors and for materials as the project progresses. That's one less thing that your lender has to worry about. It can also be combined with our Green Choice Mortgage, which can be used for energy and water efficiency improvements and upgrades. We'll go to the next slide. Okay, so Choice Renovation Express is our sort of streamlined product that offers financing options for borrowers looking for those smaller scale projects. So renovation costs should not exceed 10% of the as completed value for the transaction. And we also do a lot of focusing on sort of our rural markets here within our team. And so we also allowed up to 15% renovation costs in those high needs rural areas. Another great feature that lenders can also sell Choice Renovation Express to Freddie Mac prior to the completion of the renovation of those features without recourse. The renovations just need to be completed within 180 days the note date. And one recent improvement to our Choice Renovation project. On the prior slide, we just increased the completion time from 365 days to 450 days to get all of those upgrades completed. So we had some renovation products, exceeding that 365-day timeline due to supply chain and material shortages. So we wanted to give our lenders and the homeowners some additional flexibility on the time they take to complete those larger scale projects. So just to recap, 180 days for the smaller scale, up to 450 days for the Choice Renovation products for the larger improvements. All right, we can go into the next slide. Okay, and this is also just an example of how you could calculate the total amount that you can have for those larger scale projects. So say your property costs $75,000, your improvements came in at $175,000. And so we allowed up to that, 75% of the total value of that $250,000, the combination of the sales price and the improvements. So you have up to $187,500 to make those allowable improvement costs. And it can also be as low as a 97% loan to value for our mortgage as well, when you combine it with our Home Possible offerings for just a 3% down requirement total. Next page. And we just have a few resources for you on this page and the next that you can take a look at through the presentation and click on those as you go. And I think that is it for our Choice Renovation suite.
Hi, my name is Jim Reagan. I'm with Advisors Mortgage, and I'd like to thank Christy and Ebony and Bruce for inviting me today. I hope I can give you some practical information. I'd also like to thank my old friend Jennifer Murphy from the Homeownership Council of America for referring me to you guys. I'm looking forward to giving you some information based on some experience. I originated my first 203K in 1988 and have focused on renovation programs since then. I work with a group of 5 people. Our team at Advisors is a group of experts who provide product-specific support to our sales teams, to our referral partners, and certainly to our borrowers. And what Fix-It Mortgage is a product line. What we decided to do at Advisors when I got here in 2016 was look at the programs, the 203K, HomeStyle, Choice Renovation. They're all great programs. And what we wanted to do was bundle them into an offering or a brand that had a good message to it. And we came up with Fix-It Mortgage, buy it, fix it, love it. And what I'd like to do today is try to synthesize some of the information you heard from Deborah and Catherine and Jeff. You can see that there's a lot of information behind renovation loans, and there is. I've been focusing on them for more than 30 years, and we still learn things as we go along. So again, what I'd like to do is synthesize some of that information, maybe summarize it for you a little bit, and give you a couple of cheat sheets that may help you. Because when you talk to somebody as a housing counselor, people are going to come to you with questions. They're going to want to know, how can I buy a house that needs some work? How can I buy a house as is? Whether it's a fixer-upper or a handyman special or a HUD home or an REO, or they really want an answer to that question. And then they want to know, where's the money going to come from? And then they want to know, how am I going to get the work done? So I want to drill down on some of that information for you with some practical answers that we've learned along the way. Next slide, please. This is a slide you're certainly welcome to. You'll get it in the PowerPoint. I encourage you to just keep this around. We call this the peripheral benefits of renovation loans. This is not specific to 203K or HomeStyle or choice renovation. It's the peripheral benefits, if you will, to all of them. Fixer-upper opportunities give any qualified borrower at any income level an affordable solution to buy homes that are discounted because of their age, condition, or status. You know, in the marketplace, people have certain perceptions about things, and often people's perception about the 203K or renovation loans is that it takes too long. There's a lot of added details. It never closes on time. And those are misperceptions. Those are things that create fear, and we need to remove the fear and help people get prepared to take advantage of opportunities. The opportunities in older homes is not just blown out properties that need total restoration, but they are older properties. They are expired listings. They are any property that needs something because of its age, condition, or status. Those properties, any buyer who qualifies can buy with the right financing solution. With a renovation loan, home buyers borrow both the purchase money and renovation funds in a single mortgage loan, and they can close as is. Again, the peripheral benefit, the features and benefits of these loans are very similar. They all, as you could see from the detail, have some differences. I encourage you to make sure that you have a referral partner, a lender who has a team like ours, if you will, a group of experts who really focus on these programs, not just somebody who may say, yeah, no problem, we've done one of those, but people who really can bring the experience to the table and help your clients. Down payment can be as little as 3%. You heard Jeff say 3% in the first-time homebuyer programs. That applies both on the Fannie Mae HomeStyle and Freddie Mac Choice Renovation. Loan amounts are based on the after improved value of the property. You heard information about the appraisal. It's based on the appraiser's analysis of the property using the hypothetical assumption that it has been completed by a review of the plan for repairs and the normal appraisal information. So FHA 203K is certainly the foundation of renovation lending. And it originated in the early 60s. It was rewritten in the 90s by Ken Crandall, who was the chief architect at HUD at the time. And he had a real eye on practical changes when he rewrote the program through a number of mortgagee letters at the time. But this is not just 203K. It is FHA 203K standard, FHA 203K limited, Fannie Mae HomeStyle, Home Ready with renovation for first-time home buyers, HomeStyle investors, HomeStyle single family, and Freddie Mac Choice Renovation single family can be used by investors. The repairs or improvements are done after the loan is closed. After the loan is closed. You can close as is, and you can close on time. Most people have a perception that renovation loans take forever to close. They don't. When you have the right recipe and you have experts in position to support the transaction, I can tell you that our average turnaround time from application to closing on our purchase business is less than 45 days. So you can get the work done in a reasonable amount of time. It's all about experienced people holding the hand of the borrower and having the right service providers in the transaction. At closing, the seller is paid and an escrow is established for the homeowner to fund the improvements. Okay. these are some of the peripheral benefits around renovation loans. It's also for 1 to 4 family property. FHA loans, of course, are all owner occupied. Somebody can occupy the ground floor unit and have 3 apartments generating income. It can also be on mixed use property. 51% of a mixed use property has to be for the residential use in the property, but you can use it for mixed use properties, which frankly are the foundation of most urban areas in the United States. Fannie Mae, again, does allow investor and it does allow, and Choice Renovation does allow investor for single family properties. I think what we should do is at the end, we can pick up the questions. I'll be happy to answer any of the questions that you have that you drop into the Q&A while we're talking. So if we can go to the next slide. Again, this one was, oh, there you go. No CO required to close. You know, a lot of times when we're talking to realtors, we end up talking about that for a little while because they're so used to needing a certificate of occupancy to close on every traditional transaction. It's not that way with a renovation loan. There is no CO required to close. We get a CO when the project is completed. We're going to do draw administration, management of the draw account during the process, and on completion, a certificate of occupancy is required. I'd like you to walk you through this slide. This, again, is generic to renovation loans, if you will. All renovation loans have the same simple mathematical formula. And if we walk through this a little bit, you'll see the importance of the factors in the formula and in the information as it comes into the transaction. So sales price plus repairs, and I'll tell you about that 20% in just a second. Sales price plus repairs equals the total investment. The first thing you want to do is take a look at the total investment based on the after improved value to make sure that the homeowner, the home buyer, is getting a good transaction. When we talk to realtors, they always want to make sure that nobody's underwater at the end of the day. And they're always thinking about this, whether they do it formally or not. Sales price plus repairs, total investment compared to the after improved value. Okay. So now let's talk about where the numbers come from. When someone's looking at a house, then obviously the sales price is going to, you begin at the listing price. So where's the repair number come from? At the end of the day, during the process of the loan, in most cases, there's going to be a construction consultant or a HUD consultant that does an inspection, puts the plan together, called the specifications of repair, and formalizes that amount. Okay. But in the beginning, we're looking for a ballpark number. So how do you get that? Let's use a couple of examples. If it's an REO property, a bank-owned property, or a HUD home, there's an inspection in the file. In an REO property, the bank that lists the property, their first assignment to the listing agent is called a BPO, a broker price opinion. The broker is responsible to do an inspection, have a list of repairs that are necessary, and then a cost to cure. So there is some idea of the repairs as you go into a transaction. And it's important to get the conversation started about that, and the sooner the better, of course. In the case, if it's not an REO, if it's just a listed property that happens to be listed as is, or you've got an older home that a retired couple's now going to be moving to Florida, and they still have orange countertops and avocado appliances, but they're in great shape. You know, how do you know how much that kitchen costs? Well, again, this number is really just the beginning. It's a ballpark number to get somebody to understand their budget, if you will. And most realtors know how much it costs to to renovate a kitchen. Or somebody will know a contractor who can come in and get that first price on the kitchen. But it's important that that somebody look at the home who knows what they're looking at to get an idea of the repair number. Again, that first repair number is not the final number. We're going to go through a process of inspection and a process of putting that plan together formally, and through the appraisal process to get the firm number, but to get in the ballpark, not necessarily on the pitcher's mound, but to get in the ballpark is important right in the beginning. So again, it's sales price plus repairs, total investment after improved value. Then you know that you have a good opportunity. Okay, let's look at the other side of the formula. The other side is qualification or pre-approval. You know, traditionally in the mortgage business, or as you take someone through counseling, you're looking at credit, income, and asset. So you're going to be answering that question, how do I get the money? Well, you have to be qualified for it. So it's the same start here. We're looking at credit, income, and asset. We're getting an understanding of how much someone qualifies for. But there's a change in the focus. If someone may be interested in an older home or a home that may need some work, the focus is have a conversation about the loan amount, and the loan amount represents sales price plus repairs. That's the change in focus, not just to focus on the income and the credit to someone's maximum borrowing power, but a focus in on the loan amount. It represents sales price plus repairs. So it's again just a little bit of a difference in the focus when we talk to somebody about pre-approval. Now let's look at the trail of the money in the mathematics. Okay, when we close the loan, it's the formula: sales price plus repairs times the loan to value. 96.5% for an FHA loan, 95 for a first-time home buyer conventional loans, 97 first-time home buyer conventional loans, or 95 when it's not a first-time home buyer is the maximum LTV. For an investor, the loan to value changes, of course. The program allows it to go to 85% loan to value. But frankly, when we're talking to people, we encourage them to go to 75% or 80% because the loan level pricing adjustments are more reasonable. So sales price plus repairs times the LTV gives you a loan amount. The credits when you go to the closing table are the loan amount plus the down payment. The seller is paid. The real estate partner gets paid. The repair money goes into an escrow for the homeowner. After closing, the repair work begins and is paid through the inspections and draw requests. That's the fundamental design of every renovation loan. And what I wanted to do was try to synthesize a lot of the data, summarize it, and give you these 2 pages as a cheat sheet, if you will, because as a housing counselor, certainly it's difficult to learn all of the details. But if you can refer to these fundamentals in order to say, yes, you can buy a home that needs repairs, and you can give somebody the answer about how do I get the money, the qualification, the credit, income, and asset qualities. And thirdly, how do I get the job done? Well, it's a process of the inspection, a plan for the improvements, closing, then going into escrow. Then the escrow is established, going through the process with the contractor. Those are the fundamentals of every renovation loan. And what I'd like to get you to think about is, next slide, please, is the application of this. Okay, so this is an example. This is Monmouth County, New Jersey. And if you go to the next one, it'll give us the highlight. The next slide, please. This is a look at the age of property specific to Monmouth County, New Jersey. 86.5% of property is 30 years old and older. Nationally, the number now is like 39%. But the point is, there's a lot of older properties in every neighborhood. And right now, with the problem we have in the industry with inventory, if older properties that may need a little bit of work, instead of people not seeing them as viable inventory, if we can look to them as more inventory, it certainly would be helpful. And sometimes, as properties are offered, if they're offered only as is or cash only, then realtors have a very small potential buyer population. The next one, please. The people who can buy homes as investors in cash represent a very small percentage of the population. The greater percentage of population are people who can buy as owner occupants. And if you look at the higher percentages in these income levels, this is where those millennials live. This is the kind of income levels they're experiencing now. These are people that are looking for household formations. They're looking for the opportunity to buy homes. And homes that are offered that need some work are less expensive. And everybody is looking at affordability now at every income level in every area of the country. The next slide, please. There's the percentage. If you look at the potential buyer population as owner occupants against properties that are normally sold just to investors at a much smaller percentage. The next one, please. So when you have brought someone through housing counseling and you have qualified them, and they then go out and find a realtor and try to find their dream home, what happens today in the marketplace? Well, they may be able to find a house that fits their dream, but it doesn't necessarily fit their budget. So what happens then? They're going to go out and try to look for something they can afford. The next slide, please. What they find is something a little bit different. A house with jalousied windows and you can see the masonry steps and the iron railings, and it needs a paint job and perhaps a new roof, and you know that it's going to need a good kitchen remodel. The next slide, please. What we really need to try to help people do is remove the fear and be prepared to look at older homes that might become opportunities. And it just reminds us of Wayne Gretzky's quote, I skate to where the puck is going to be, not to where it has been. That's what we need to try to help people to do. Get in the mindset that, okay, I'm going to look at older homes that might need some work. How can I get prepared to execute on that? The next slide, please. So we're going to try to help them. We're going to try to help buyers looking at homes like this. Go ahead with a kitchen like that. Now you wouldn't necessarily want to go in there and cook that Thanksgiving dinner, but you would want to go into the kitchen that you can remodel. Go to the next one. You'll see the kitchen. There it is. So somebody who is looking at an older home that needs work, we need to help them with the vision to see how that can become how they can accomplish that. And from the economical perspective that Simone talked about earlier, I have found in looking at these loans for 30 plus years, somebody, when they close on a home that has been discounted because of its condition, the pickup in equity immediately is between 13 and 17%. So it is an opportunity where someone can go right into homeownership and begin to build wealth for their family. And along the way, they can buy the house as is, get the money to buy it, and get the money to build that new kitchen and do all those improvements. It's an opportunity for somebody to take advantage of less expensive properties. And some of the other things, if you go to the next slide, please. There's just an example of this particular property. It's from a couple of years ago. And what I wanted to give you examples of is the answers. How do I get the money? You can finance purchase money plus a paint job, a new roof, move a wall. You can do all of those things. The object here is to tell someone you can buy a fixer-upper. You can say yes to that first question. Can I buy a house that needs work? And then the answer to, how do I get the job done? It's a process in the loan, and you need experts to help you. It's walking through this and not making a product decision necessarily right up front, but it's to, as a housing counselor, if you can evaluate someone's qualifications, you're going to know whether they're an FHA borrower or a first-time home buyer or a conventional borrower. If you begin to make those decisions based on the variables, and then they go look at property with realtors who understand the product, and we can encourage them with the information about the program, and that they can close on time. There are just more opportunities available, and we can help people find them. You can help buyers buy a fixer-upper. The next slide, please. You can also help by the pre-approvals you may have done with your clients. The pre-approvals you've done, if you did them 6 or 9 months ago, you really ought to go back and do them again, because you should update the math, you should update the documents. We encourage people to add an advantage to their pre-approval and talk about a plan to improve. Just initiate the conversation so that they're not afraid of looking at an older home. It's really an opportunity to help them get prepared and get rid of some of the fear that might might come in if they look at a property that needs some work. If you look at the next one, we've also designed some help for listing opportunities to help address the inventory issues in the marketplace. You know, I use the example of a retired couple. Maybe they want to move to Florida and they're not going to update the kitchen. Well, if a realtor has a better sales strategy to help somebody sell a property as is, they can let buyers make that home their own. They can let buyers or encourage buyers to come in and use their own vision to pick the colors and cabinets and countertops. Older homes, when the seller does not have the cash to update, are an opportunity. Expired listings that have expired, they only expire for 2 reasons. They've either been priced too high or they have a condition issue. You can help them solve those kinds of issues with the right application of any of these products. The next one. Okay, that's if I could, let me just kind of take a look at the questions real quick. Does the HomeStyle or Choice product exclude the community seconds? It really depends on the community second and how it is designed, Anthony. How is it explained to a first-time home buyer looking for a home? They want a purchase rental loan product, but they have no idea how much the renovations will cost, but they have a mixed loan approval. So will they have to pay someone to give them an estimate? Not necessarily. If you use like the example I gave you, if there's an opportunity, depending on how much work needs to be done, if you can get that first ballpark estimate from somebody who knows what they're looking at, a contractor as an example, or HUD consultants can do a report called a feasibility study. A feasibility study by a HUD consultant, it's going to cost a couple of $100, but it will give somebody the opportunity to take a look at the costs of the renovation. Okay, I think that's about all I have for you. Ebony?
Yes, sir. Thank you so much. And thank you everyone for your presentations. I hope that everyone was able to learn something about 203K loans. So now we're going to open the floor for any questions that you may have. And I'll go through the questions that were added to the Q&A box. So the first question is, oh, wait, no, not that one. Hold on. Okay, so the first question is, what are the credit and income requirements for existing owners? And any of you can answer these questions.
Sorry, can you read that one more time, please?
Sure. What are the credit and income requirements for existing owners?
Okay, you qualify for this loan in the same manner as you qualify for any Fannie Mae, for any purchase or refinance loan. In other words, the qualifications for a renovation loan are no different. Okay, the borrower income requirements, the LTVs, the DTIs, et cetera, are no different than a standard refinance loan. We don't have different credit requirements. I'd say the only real difference here is that you're qualifying for a higher amount, right? The amount includes the renovations. So your debt to income ratio will represent the payment, the payments for that entire amount, right? For the amount of the renovation loan. But honestly, the credit requirements, the LTV, the DTI, the FICOs, et cetera, are identical to our refinance loan. Thank you.
Thank you, Jeff. Next question is, does Fannie Mae have a preferred list of lenders that provide these home improvement loans or products?
No, we don't. And the reason is that Fannie Mae, there are lenders that work with Fannie Mae. There are many of those lenders also work with Freddie Mac. Many lenders work exclusively with Freddie Mac. Many lenders perhaps don't work with either of us. We don't want to publish a list because we don't want to favor one lender over another. There are many, you could search for HomeStyle renovation or search for renovation loans and speak with lenders about it. But the answer is no, we do not. We don't publish a list of loans, a list of lenders who have our loans available.
Hi, on the FHA side, we do have on HUD.gov, our website, a list of 203K consultants. We have a list of lenders and all products that the various lenders lend in what arenas, say 203K, reverse mortgages, which we call HECMs. There's also Title I loans for smaller type of rehab. So they are all listed on HUD.gov.
And for Freddie Mac, also on the resource slide that I provided in the presentation, if you can take a look at that, there's actually a link to our website that will list some lenders that offer our choice renovation programs. So it's sort of an opt-in list for those lenders that wish to be posted publicly, but it's not all encompassing, but there's a pretty decent list out there if you want to take a look.
All right, thank you everyone for your answers. And again, the copy of this presentation will be sent out via email within 24 hours. So the next one is more of a comment. It says, I use the weatherization program for my home. It's wonderful. It sent improvements to insurance, reduced insurance, and utility bills. The next question is, when do payments come due for the escrowed funds? And again, any of you can answer this.
Sure. This is Jeff Seidelman from Fannie Mae. The borrower makes, well, the funds that are escrowed for the renovation are part of the loan. And the payments are due on that loan, a month or two after the loan closes. In other words, the borrower has established a loan for the entire amount when the loan closes and makes payment on that entire loan amount at that point. There's a big difference between this and a construction loan. You all may be familiar with a construction loan where there's a draw, where a borrower draws and he only pays interest on the amount that's borrowed. A renovation loan does not work that way. A renovation loan with Fannie Mae, you make the payments for the entire loan amount during the renovation. Okay, those, if you have a 30-year fixed rate mortgage, you're going to have the same principal and interest payment for the entire 30 years, even though you might be making improvements or making those renovations in the first 6 months. I hope that answers your question.
Thank you.
Ebony, if I may, let me add that
Sure.
all of the programs are the same as Jeff just described. All of the money is borrowed at the closing. It's a fully funded loan. The first payment is due on the first of the month after a full calendar month. And again, and I think it was Jeff that mentioned earlier, each of them have an opportunity where someone can borrow the principal interest mortgage, the principal interest, the PITI during the construction period can be borrowed by an owner occupant, so you don't double up on their budget during construction.
That is correct. You can borrow. You can include up to 6 months of PITI in the renovation. If the house is not occupiable during the renovation.
Right. That's on the FHA side. That's what I was just going to clarify. Up to 6 months. If the repairs render the property uninhabitable. So this way, those payments the lender puts in escrow and makes the payments basically on behalf of the borrower as the repairs are being completed.
All right, thank you all for your answers. I'm not sure, there's a question here by Veronica. It says, is this work for refinance or ADU new construction? So I'm not sure if you guys have an answer for that, or maybe Veronica can elaborate on her question. All right, so the next question. And again, if you guys have questions, please add them to the Q&A box and not the chat box.
Yeah, I was going to say with the 203K loan, we don't allow new construction.
Okay.
The new construction requirements are something outside of our 203K. It's called a rehabilitation loan. You need to use the footprint of the existing foundation. So new construction is not included under our 203K product.
Yeah, and that's true for Fannie Mae's product as well. We do have a separate construction loan. It's construction to permanent financing, and it operates differently than our renovation loan. But you can use our renovation for everything up to and including a gut rehab. But if you're demolishing a property and building it, or you're just building a new property on ground that does not have a property on it today, that is what you would use a construction to permanent financing loan for. Thank you.
Yep, same as Jeffrey just stated. FHA has the same type of product, but that has two closings. Construction to perm, we call it. There's two closings, one to finance the new construction cost and the other to tie everything together at the end of the new construction.
All right, thank you guys. So the next question is the community. I'm not sure if you answered this one, Jim, but it says, is the community second is designed as a lien that the payment will begin 5 years after closing with 20 amortization. Will HomeStyle or Choice not count the payment in debt ratios? I'm not sure if I read that right.
Yeah, I understand that. I actually do not know that off the top of my head. If it is possible for me to follow up after this call with whomever posted that question, I would appreciate it.
Okay, and so Anthony Thomas, if you want to, you can send me an email and I'll get it over to them so that they can answer this question for you.
Right,
And
that could go to all three of us. Then it's not necessarily, I believe that the others have offerings that are similar.
okay, well, if you'd like, you can type your email address within the chat box and Anthony Thomas can get to you directly. All right, so the next question is, are there additional closing costs for combined first mortgage and rehab loans?
So I'd like to just start on that one. It's they're not, well, let me explain it this way. The added costs for a renovation loan, inspection, title updates, architect fees, things like that, the ancillary costs of a renovation loan, all of those are financeable within the renovation costs. So it doesn't increase someone's cash to close. So that's point number one. Point number two, whoever asked the question, it sounded like your feeling is that there are two loans. Again, they are not. It's one loan, fully funded. All the money is borrowed at the closing table. Again, it's in the mathematics. Sales price plus repairs times the loan to value gives you the loan amount. Fully funded, sales price plus repairs.
Okay, next question. As CDFI, can we get approved through Fannie and Freddie to access these programs?
I can take it for Fannie Mae. For Fannie Mae, you do need to apply to access our HomeStyle renovation program. HomeStyle Energy is available to any lender. I don't know who I'm speaking with, but you do have to be an approved Fannie Mae lender to sell loans to us. So if you are already approved lender, then you can deliver HomeStyle Energy loans to us today. You would need to be approved, and you need a separate approval to deliver HomeStyle renovation loans before the renovations are completed.
And I'll speak up for Freddie Mac. It's the same with Freddie Mac.
Okay. All right, I think that's going to be it for today. I hope you guys have all of your questions answered. And I'm going to turn this part of the presentation over to Bruce so that he can give final remarks and to close us out for the day.
Cool. And thanks everybody for being a marathoner. I know it was long and a little bit longer than we planned, but very valuable. This will be a recording so you can make it available to other staff people. And it'll be posted on our website. Ebony does that as well. So just a quick reminder about joining NHRC. We do have a deep discount on CoreLogic credit reports. I know the credit report costs have gone up, especially for tri-merge and with credit scores. And we seem to be a very good deal for people out there. And so please consider that. There's other advantages as well. We do post unusual funding opportunities, some of which groups have taken advantage of, and there are things that you might not normally see. But the main reason is you're supporting our work to continue to be able to do this, to lobby and to be advocates for housing counseling in the public space. So get to be a member and try to get on the inside of that. We would appreciate it. So that's it for today. Feel free to email the staff if you've got any questions or thoughts you want to share. If you've got some thoughts about what to do on the CFPB meeting coming up, please shoot me an email. It would be good to queue up a few issues ahead of time that we were able to raise in the context of the meeting. So it'd be great to do that. Thanks, everybody, and we will talk with you at the next session.